Most real estate agents overpay on taxes, and that's specifically with the self-employment taxes. That's where an S corporation can help you save thousands on your taxes. This video, I'm going to go over when it makes sense to be an S corporation as a real estate agent and how to make that election. So, why should agents care about that S corporation? Well, as an 1099 agent, so you get a 1099 for your commission income. Your income on your taxes, in addition to paying the regular income tax, you would pay an additional self-employment tax, and that rate's about 15.3% of the income from your business after all your deductions. So if you make $100,000 net, then you would be paying about $15,300 in addition to your income tax. That $15,000 would be your self-employment tax that you would get hit with. The S corporation lets you split your income out into a payroll, which would be subject to the payroll taxes, which is the same thing as that self-employment tax. It's your FICA and your Social Security, or your Social Security and Medicare, I should say. And then the rest is your business income that you can take out as draws, and that money would not be subject to that 15.3 employment tax. It's one of the best tax-saving strategies out there for high-earning real estate agents. So, what exactly does an S-Corp election do? Well, it's actually a tax election. So you would have to have an LLC, first of all, to have this, because you have to have a business entity set up. So that LLC, you would make that election, and you do that with a Form 2553 that you file with the IRS. And that makes an election for your LLC to be taxed using the S corporation tax form. Your LLC doesn't change. It stays put and in place as an LLC. Legally, it stays the same. It's just you're designating which tax form to use. There's actually 4 tax forms that can be used to file a business tax return. One of the main reasons LLCs are so popular is because an LLC can be taxed using any of those tax forms. Now, most people, most real estate agents I'm talking to are going to be self-employed, single member LLC, and you're going to default to being taxed as a self-employed on Schedule C. But that election just says, no, I don't want to use that tax form. I want to use the S corporation tax form. So, And when you do that, the S corporation itself is not subject to those self-employment taxes. So you're going to save that money by making that election. Now, you do have to pay that reasonable salary, and that would be subject to the employment taxes. As I mentioned, same thing, Social Security, Medicare, taxes, and it's the same 15.3% because you're the employer. You're paying both portions of that employment tax. It's called something different, but it all goes to Social Security and Medicare. So when does it really make sense? Well, in order to have tax savings, you need to have enough taxes that you're paying to get enough savings to outweigh some additional costs that are going to be required when you are an S corporation. So we want kind of general rule of thumb, somewhere in the $50,000 to $60,000 of net profit. So that's your commission income less all your expenses. Or, probably going to be in the, 75, 80 to 100,000 is when it start of gross commission income, I should say. So 80 to 100,000 of gross commission income is probably where you're going to start seeing that net profit level, that it makes sense that the savings are going to start outweighing some additional costs that you need. And so what are those additional costs? Well, a payroll. So you're going to need to pay somebody to actually process your payroll that we're going to get. Talk a little bit more of that as we go along. You're also going to have a separate tax return. So you would need additional tax preparation fees. Definitely need a CPA or a tax professional to help you out at this point. So maybe you're not even, if you're filing your taxes yourself, you would really need to get a CPA or a tax professional, and those cost money. So that 60,000 net profit, or that 80 to 100 gross commission income, that's kind of general rule of thumb where the tax savings are going to outweigh those. Who should not be an S corporation? Well, obviously, if you're under those income amounts that I mentioned, you're not going to have enough tax savings. So tax-wise, you're not going to see that savings. So you may not want to be an S corporation of those. If you don't want to just deal with that payroll, it's an additional administrative burden and cost. And if you don't want to do that, then S corporation is not something you should be looking at. If you're looking to get out of real estate, if you're retiring or something, maybe in the near future, you may not want to be an S corporation, and you are doing your taxes yourself, and you don't want to hire a CPA or a tax professional, then I wouldn't DIY the S corporation. So you really do want to be or not be an S corporation if you're not going to hire a CPA or tax professional. So let's go back to that reasonable salary when you are an S corporation. So what is a reasonable salary? Well, that's all the IRS states, is that an S corporation, anybody owning and working in the corporation, needs to be paid a reasonable salary. And they don't define what reasonable is. There's a lot of court cases and things out there. Most professionals use some sort of rule of thumb there. What their IRS is really looking for is people paying unreasonably low salaries, because you're avoiding more of those employment taxes, and that's what they do not like. So that's where they go after people paying that unreasonably low. So let's say you have $100,000 of net profit. You don't want to pay yourself $10,000, let's say, and put the other 90 as profits that you take out as distributions. That would probably be unreasonably low. Typically, most professionals out there will stay within somewhere around that 40 to 60%. If you go higher, you're not going to be at risk as much as you go lower, for sure. But that 40 to 60% of your net profit is kind of the general rule of thumb you'll hear out there for most people. So if you're making that $100,000 of net profit, somewhere between the 50 and 60 is probably what most people would call a reasonable salary. It's really going to be dependent on you and how much you make and how involved you are, and if you have other people doing it. There's a lot of factors you can take into account, but that's generally kind of the rule of thumb. And as I said, the IRS is really more looking at those unreasonably low. So the higher you go, the less risk you are at an audit or being reclassed. Because if it is determined you are unreasonably low, they could just reclass all the profit back as salaries, and then you lose all the tax benefits of the S corporation. So you want to make sure you're in a reasonable kind of range. So how do you make that S election? As I mentioned, it's Form 2553. It's a simple IRS form. You could fill it out yourself. This is part of it. You could DIY, but you're going to probably be working with a CPA or tax professional, and they'll handle the actual filing for it. What's important to know is it is a timely filing that you need. It's due March 15th if you're a calendar year, and everybody should be a calendar year taxpayer business on your S corporation. So it would be due March 15th, and that's March 15th of the year in which you're filing, not the year after like your tax return would be due. It is, so right now we're in January of 2026, and that filing for the 2026 tax year would be due March 15th. If you're trying to file last year's 2025 tax return, that form 2553 was actually due last March, so you're late on that. So that's when it's normally due. And those late elections, as I mentioned, you can make a election late. If you miss that tax deadline, or that filing deadline, I should say, of March 15th, you can make the election later. It just takes another step, and there's additional information to fill out on the form. Again, your CPA or tax professional will be able to help you out with that, but you want to do it. The important thing is you still want to get that payroll in from last year. So if you're trying to do it now, after the end of the year, you may not be able to go back and say you paid yourself payroll for last year, so you may not meet those requirements. So that's really the important thing to do, is make sure you get those payrolls in, but you can make that election late. So what happens after you file that election? Well, you need to get that payroll set up. That's the first thing you need to do, is get payroll set up with some provider. Again, don't DIY this. Get a payroll provider. Some CPAs will do that for you, or you can use a service like Gusto or ADP or one of those. They will be able to process that payroll for you. They'll get you your W-2 at the end of the year, and they'll pay quarterly taxes for you. The quarterly payroll taxes, I should say, related to that payroll. There are quarterly payroll taxes at a federal level, and there may be some at your state level as well. Check with your state or your tax professional to make sure you're getting those state filings for payroll as well. And that's really why it's important to use some sort of professional with that payroll. And then at the end of the year, as an S corporation, you would file Form 1120-S. That's the S corporation tax return. The important thing to note out there is that it has a different tax deadline. It is not due April 15th. It is actually due March 15th, a whole month earlier. So a lot of people miss that deadline. You can extend it, but you have to get that extension in by March 15th as well. So don't miss that. If you make that S-Corp election, you need to at least extend it, if not file it by that March 15th deadline. And if you extend it, it's due September 15th, which is still 1 month earlier than the October 15th deadline of a personal tax return. So you are on a different tax deadline when it comes to that business 1120-S S corporation tax return. Your personal return is still going to be due April 15th. Just the business will be due that month earlier, because it's going to generate a K-1, and this is why it's due a month earlier. That K-1 out of that 1120-S, along with your W-2 from your payroll company, that's what goes into your personal tax return, and you'll pay the taxes on your personal return from the business, but you need that done first. Get that K-1, get your W-2 from your payroll company, and that's what you need to put in for your personal return. What requirements are there when it comes to payroll, and what's it going to cost you? Well, like I said, this is something you don't want to DIY. You need to get a payroll company or a CPA. You're probably looking anywhere from $40 to $150. I mean, they range out there depending on what you need and if you have state taxes and things like that. So you want to run it at least quarterly, because you need those quarterly tax returns. But you can set up a regular payment schedule, or you can probably even just pay yourself anytime you get a commission check or whenever. So you need to get that set up. But like I said, you need to pay yourself quarterly, or at least file quarterly payroll taxes. They're due even if you don't pay yourself in a particular quarter. You still have to file those tax returns with a zero tax, or they're going to think you missed a filing. So you definitely need to pay or file something quarterly. With that, you're going to withhold the Social Security, the Medicare tax from your paycheck, you're also going to withhold federal withholdings on that. And that's where you can actually increase that to pay some of your quarterly estimated taxes, or you just pay whatever withholding based on what you actually pay yourself. You would still need quarterly estimated taxes on whatever's left over in the S corporation that you're going to take out as distributions. And so you withhold that taxes, and then you as the employer would pay the Social Security Medicare tax employer portion, and you would remit that to the IRS on at least a quarterly basis. That's what that quarterly tax return is telling the IRS how much it is and who it goes to. And so that's the important part of that. Let's talk about what tax savings would be with and without the S corporation. So let's go with that $100,000, make it nice, neat, round number, $100,000 of net profit in your real estate business. And we're only going to look at the self-employment portion. We're not going to look at the regular income tax because that won't change with an S corporation or without. You're still going to pay the same amount of regular income tax. We're only going to look at the self-employment tax. So as I mentioned back at the beginning, $100,000 of self-employment income, if you are not an S corporation, would account to $15,300 of self-employment tax. So let's look at that, compare that then with the S corporation. And let's use a salary of $60,000. So that $60,000 salary, it's going to go through, we're going to have employee, and employer portion of the Social Security Medicare taxes, still that 15.3%. That's going to come out to $9,180 of employment taxes. The remaining 40 of income is just going to be profit in the S corporation. You can take that out as a distribution. Those distributions are not tax, are not subject to the self-employment tax. The profit in that business is not subject to the self-employment tax. So that $40,000 pays zero self-employment tax, which of course is $0. Which that then, in that scenario of $100,000 income, $60,000 of it in salary, you get a savings of $6,120 in self-employment tax. So that's pretty good savings there on $100,000. A little over 6% you're saving on self-employment taxes. Now, you're going to you're going to have to reduce that for the additional expenses you're going to have for payroll, and an additional tax return, but still you're not going to pay $6,000 for those services. So that's where that income can really, it really needs to be higher to save that money, so you're getting some tax savings, and you can see it there in that example. Okay. Now that we've gone through all that, let's talk about some of the biggest mistakes real estate agents make with electing an S corporation. So they do it too early in some cases, so they don't get that tax savings just because, it can save you money on self-employment taxes. Doesn't mean it will. So you want to make sure you're there at that level, that it's going to make sense, and you don't make this election too early. Another big mistake is not paying or paying an unreasonably low salary. That is a big red flag, something they focus on. If you don't pay yourself anything, it's really noted on the face of the on that form 1120S. They know exactly who it is, how much you've paid yourself, and so they can do the math real easy with the computer systems. So it is a big red flag and something you don't want to get wrong. Another mistake is they're not consistently running those payroll, and they get behind on payroll taxes and payroll filings. So make sure if you are an S corporation, you're paying and running those payrolls on a appropriate schedule. Biggest mistake is people trying to do this without professional guidance from a CPA or another tax professional. This is not, it's a very complex return. There's a lot of nuances to being an S corporation to make sure you're doing all these things right, and you need that guidance from a CPA or other tax professional. And again, the other mistake is forgetting about the S corp filing deadlines that are different than your personal. So a lot of people miss that deadline because they don't realize it has a different date, and that can cost you large late penalties. So don't miss out on that. So what do you need to do right now to determine if you should be an S corporation? Well, figure out, now we're in January, but at any point in the year, know what income level on a net after all your deductions, I should say, was, and you can look at that on your Schedule C if you're not an S corporation, and see what kind of income level you had there. Project out this year and keep an eye on it as the year goes on. As you get closer and closer to that number, you may want to start contacting your CPA or tax professional and having a discussion about the S corporation. Don't file that form 2553 unless you have talked that through with the tax professional. Make sure you get that guidance and don't jump the gun on it. And then factor in all those additional costs that you're going to have, your payroll costs, the actual tax return costs, and figure out what additional costs are going to be so you can project the savings and make sure you're going to get those tax savings that you need. All right. And then just make sure you talk with that professional and make sure you're in compliance with any and all other rules there might be around the S corporation in your particular instance. So that's really all I've got. S corporations are great tools. It's the biggest number one and the first strategy you should take into reducing your taxes as a real estate agent, but you want to do it at the right time. If you have any questions about any of the comments, please leave a comment below. Otherwise, thanks for watching.